Good afternoon. My paper and presentation is on behavioral finance and investor psychology. Some goals of my presentation is to explore the importance of behavioral finance, review key research and theories, and share my own personal takeaways. Um, Introduction to behavioral finance. Behavioral finance includes psychology to explain real-world behavior. Um, Traditional finance assumes investors are always rational, and emotions and mental shortcuts often shape financial decisions. Some core ideas of behavioral finance. It challenges the belief that the markets are always efficient. People act based on emotions, biases, and social pressure, and recognizing these patterns can improve decision making. Some foundational research. Kahneman and Tversky in 1979 came up with the prospect theory, which is people fear losses more than they value gains. So if you invested money and say you lost $20, people would take that more harsh than if they were to gain the $20. They would see that as a little bit of profit compared to if they lost it. And then Richard Thaler in 99 came up with mental accounting, which means people treat money differently based on context. So, for example, in my paper, I wrote how whenever some people get a bonus from their job, they see that as kind of like fun money or like anything, like they can spend it on anything instead of acting like it's a regular paycheck because money is money. Why behavioral finance matters? Because it's relevant to anyone who makes financial choices within the market. It connects theory with human behavior, and understanding psychology can improve investing outcomes. Some key psychological biases. The first one is heuristics, which are mental shortcuts. They're often flawed. Overconfidence, which leads to excessive trading. So some people think that they might know more than they actually do, or know more than their friends, which will lead them to do things on their own. And it can definitely lead to a good amount of loss. Herding is the next one, which means following the crowd despite facts. So if you see a big group of people that decide to invest in a certain stock, um, you might think to yourself like, oh, they know something that I don't. Like they must know that it's going to go up. And if that goes against your facts and your research, then it could definitely go very poorly for you. The next one is loss hatred. Avoiding loss feels stronger than gaining. And the last one is anchoring, which is relying too much on past values. So if you're caught up in the past, seeing what Bitcoin was at a year ago, then it's just not going to go well. It could go very poorly. Um, Real world relevance. It helps explain market bubbles and crashes. It helps us understand panic selling and group behavior. And traditional models alone cannot fully explain the market dynamics. It's definitely not just a theory, it's very practical. These biases explain real market behavior. Some examples are stock bubbles, holding on to losses, buying high. And then recognizing them leads to better investment habits. Some debates and criticism. Hammond says that markets self-correct over time, and Schleifer says that irrational behavior is persistent, not random. Both these go against it. Some of my personal takeaways. Bias are subtle but definitely very powerful. Um, Better awareness is equal to smarter investing, and emotional control is important as strategy for sure. Some of my final thoughts. Behavioral finance gives us a realistic view of the markets. Understanding human psychology makes theory more practical, and it's not just academic. It's a usable tool to make real world decisions. Thank you.